Welcome to the Pump and Dump channel for another weekly update, this time looking at a variety of issues or topics. First one is Guyana Goldfields. So I talked about them last year in 2019. I thought at $1.20 it was it was looking like a good thing to buy. I think it was around August here. And risk reward was looking favorable. I thought it could triple. I thought it could go down to maybe to $1 to 90 cents and stay there for a prolonged period of time, but it went down to 25 I think it was in March. Yeah, in March it went down to 25, melted completely, and now they're being bought out by Silvercorp Metals, and that's kind of why they're trading here at 65, because of the acquisition price is based off of like 60 cents, and I think it's like converting into so and so many shares. So depending on what Silvercorp Metal does, the value of the Guyana Goldfields shares will change. So yeah, took an L on this. Overall, I think because I did buy some afterwards, in the 80s, and also after it whenever it was, it crashed somewhere here, I guess. Yeah, in October 2019 I bought some there again at 50, and yeah, it just didn't work out, I would say. Just the way it goes. My opinion, there was limited downside risk. It wasn't a complete trash stock, or it wasn't one where I'd look at it and say this has to go to zero. I just think that the issue was management seemed to struggle to get things going, and they couldn't figure out some problems, some technical issues, and that's just kind of the risk that you take, because like you can't, as like a retail investor, let's say, you can't travel to all these sites and do detailed analysis and do geological work, especially if you're not in that field and you don't like know what you need to know about different types of rocks. But I thought it was looking at last year it was looking interesting, but it didn't work out. That's the way it goes, I guess. So next topic, YouTube videos on tankers and N18 in particular spawning everywhere, and it's sad, but it's the way I see it. The thing is, the algos pick up on this kind of stuff, these videos, when people are getting all excited about something and posting like, yeah, I bought myself some of this and I bought myself some of that, feeling all positive. It usually leads to the attention being reflected in the views, and the algos, they look at this and they say, you know what, the data suggests that there's lots of retail investors are getting crowding into this investment vehicle. Let's sell into them and push it down and see how long they'll be willing to hold on for. And yeah, I saw in particular one video which I thought was extremely sad. Some guy putting like 10k into shares at, I think like $8 or something crazy like that, and then he bought some more when it went down into the sixes. He bought 350 or something, like a smaller amount, a bit yeah, a bit flimsy, the whole thing. But anyway, it seemed like the guy was just buying high and hoping, and he was asking people who were also in the trade to post the hashtag I still believe. So his rationale for buying it was kind of really limited to the fact that he was saying, oh, they are making a lot of money right now, and therefore, therefore it's a good investment. Of course, in cyclicals, you buy when they're not making money, and you sell when the the market is reflecting the bull case, and the financials are reflecting the bull case, and you can start seeing the assumptions translate into profits and high cash flows, and that's kind of when you sell. And people who buy, then they're buying high and hoping that it keeps going higher. I don't know if it goes higher or lower from here. I just think it's unlikely it will go higher. I think it will not achieve the $18 a share that it had in 2015, I think, because they just lost too much money during the bear market, staying on spot rates. Remember, they were taking like $4,000 a day in the Suezmax during a period of time when the tanker rates were extremely weak, but the charters were good, but they refused to take a charter. So that's just the way it goes. But anyway, getting back to these videos, there's these guys who talk like they know something, and they talk with confidence and an attitude, but obviously they don't have the ability to assess risk and reward of an investment vehicle. You can see that in terms of how they talk and why they buy stocks. One guy was talking about he likes DHT because they have lots of VLCCs, and he likes also Euronav because they have lots of VLCCs, and it's just not the way you buy stocks unless you have like a rationale for why you really like VLCCs at this point in time. But yeah, it kind of was that way anyway. There was another guy selling calls and buying the stock and losing net, you know, on the trade. So he has like no upside from where he bought, and because the stock had tanked a lot more than the calls were worth in terms of the strike or the premium, whatever you want to call it, I just don't see how that guy can recover. So that was kind of interesting. But hey, you know, at least the guy had cool music playing in the background and he was talking like he was a big baller. Now getting to the next topic, energy subject, the energy sector. I saw some people posting in the last week about videos where they were discussing the associated natural gas supplies declining because of the oil producers having to shut in wells, and they started to recognize you know, that this was a possibility. And I think it was like 2 weeks or 3 weeks ago I saw someone of more renown who's professional investor who was talking about this too, and he wasn't talking directly about it, he just mentioned it en passant during a discussion, as they would say, and of course meant that he already knew about this before, and I also was talking about this in my videos. I think it was in mid-March or so when the oil price created on the 9th of March. Let's just bring up the CNX chart to just highlight how these things unraveled. So 9th of March, the oil price created from like 40 to 27. CNX, of course, it was trading at half intrinsic value all this period of time, and then the market started saying, hey, this idea of associated natural gas price production coming down if the oil price is too low and oil producers have to shut in. So it went from half intrinsic value to full intrinsic value, and then it came back down because I guess there were some doubters or haters, and you know, people who just like looking at it and say, you know what, there's also economic declines, you know, in terms of electricity demand and usage. Of course we do see that you know, people are staying home, they're not going to work and using electricity there, and they're not running the machinery at the factories. And then we did see the price again run to full intrinsic value, and the idea, you know, the thing is, the prices are reflecting this idea of associated natural gas production declining. And now it's really a question of whether we'll go back to a scenario where we're talking again about the economy and the demand side of the equation. So thinking about natural gas, of course Range Resources did pretty well too. And talking about like knowing what you're talking about, I can just highlight this this private placement or private offering of senior notes. They basically announced 300 million to close at 2.25% interest rate till 2026, and they gave the lender the option to buy or to issue another 45 million to add to that, and they exercised that. They want to get 2.2% over the next 6 years, because I guess the treasury notes are really low. The interest rate on the treasury notes are really low, and CNX is being perceived as a safe investment vehicle, and it probably is until 2026. It doesn't necessarily mean in terms of the stock price it will do very well, but as a safe investment for bondholders, this is, you know, a place to be. And because of course I am kind of in a position where I know the company and I can analyze it, I can just look at this here, and I calculated, and basically adding this $45 million of debt to the company's liabilities and taking the cash increases the value of the shares by 9 cents, which is not much, but you know, it does increase it. So that's kind of a thing to look at, to understand, and to know that is a, you know, it's a little positive, but at least it is a positive. It's not something you would buy the stock for, because it's up by 9 cents in terms of valuation. But yeah, that's kind of where it's at. So getting back to this idea of associated natural gas supplies declining. If we think about this rationally, if there is not enough natural gas, then what would the utilities do? Of course, they would draw on inventories. The thing is, like, when the inventories start drawing down net over year over year, there is a kind of let's say a worry that, you know, if that persists too long, then there won't be enough natural gas. So they do incentivize with higher prices natural gas producers to produce more to get the inventories back up. And this is kind of where the demand supply equation really plays into it. And yeah, if we do get to a situation where there really is a shortage of natural gas, then you would obviously benefit from the price rising, and that would benefit natural gas producers like CNX, Cab Oil and Gas, Range Resources of course too, EQT and Southwestern Energy Company. But then there's the other side of the equation. If there's not enough natural gas, then what else would benefit? Where would the demand, you know, appear, and where would the pricing maybe firm up a little bit? And that is of course coal. And BTU here, Peabody Energy, is a coal producer. Then of course you have Arch Coal, and yeah, you have some other companies in the coal space. But you have to also look at these companies in terms of thermal coal and met coal. And like in terms of thermal coal, that's what you would be looking for. Arch Coal, they have the Black Thunder mine in the Powder River Basin, which is losing money. Of course, it costs them like $12.30 a ton to produce, and they're getting $12 a ton of that, you know, for that. And the reason for that is, of course, it's low BTU, and it's yeah, it's in a place where it needs to be transported. In the Powder River Basin, the population density is not as high as, like, if you take the Appalachia region, which is they also have a mine in the Appalachia region, but it's not as big as, anywhere near as big as the Black Thunder mine. Cloud Peak Energy also used to be in the Powder River Basin, but they just folded last year, and it's just the way it goes. Then another coal mining company is Alliance Resource Partners. They have mines in the Illinois Basin and in the Appalachia region. In the Illinois Basin there's also Peabody Energy, and I remember from a 2018 presentation, Peabody Energy was basically saying their cost of production in the Illinois Basin was like $33 a ton, and the Illinois Basin pricing is about $33 a ton. I got the EIA website here. You can see the different grades to the Central and Northern Appalachian, Illinois Basin. So there you go. That's, I mean, that's based off 2018 numbers because I don't know the current ones, but I remember 2018 for Peabody Energy. And Alliance Resource Partners, they of course are also in the Illinois Basin and the Appalachia region. So their cost of production last year for the Illinois Basin was just like $26 or $27. And this year they shut the mines for the coronavirus situation in the Illinois Basin. They're operating the Appalachia region. In the Appalachia region, the reason they shut down the Illinois Basin mines is because they have inventory they can draw on, and they say, of course, they want to keep their people safe. And in the Appalachia region, they don't have any inventory, so they have to keep producing there. And they're doing this, of course, in order to fulfill their contracts that they have for delivery of coal. I think they were 87% of guidance was hedged, and they announced recently that they're just going to stick with the 87% of the production that they hedged, and they're not going to produce the other 13% unless market conditions warrant, and it's the way it goes. Now, in terms of a looking at this company doing how they would perform, in an environment where there wasn't not enough natural gas, of course coal demand would increase, and then this company of course would benefit. Maybe the other ones I mentioned would benefit more, but in terms of like valuation, I'm not really sure about them. Both of them, I think they're speculative at best, but here I know is Alliance Resource Partners because I've known them since 2000. I actually first I think I came across them in 2016 at the bottom of the market, but I didn't look into them enough, and I kind of missed the boat on them, and that's just the way it goes. But in 2017-18 I looked into them more in detail, got a good understanding, and yeah, with this company I know that for a fact that they are undervalued based upon a just a valuation that I did yeah, I did quite some time ago. So the way I see it is stock should be about trading at about $10 to $15 a share, but because of course they're in an unloved sector, coal production, nobody seems to be interested in owning them, and they also cut the distribution this quarter because they're not going to be making enough profit, I presume, so they're not going to pay distribution this quarter. It's like the first time they haven't paid a distribution in many years. I don't remember if they ever did cut it in the past, but they had to announce that they were not going to pay it. I would link that to the drop in demand and their inability to therefore sell the 13% of what they were planning to sell into the spot markets at prices that were reasonable to them. But yeah, I think this is like a $10 stock at least, $15 peak. We'll see if I'm proven to be right, but in terms of where it is, where it should go, I think this is a winner. And if natural gas works out, then I presume this will work out too. And if natural gas doesn't work out, then this might not work out. But in terms of the price to the valuation, I think it's very cheap. So I think I have enough of a margin of safety in case my theory does not play out going into the winter. Of course, the most important thing to factor in is that looking at like my analysis over the years, just picking up pieces here and there, I remember that around like $2 an MCF, it seems like the utilities favor natural gas over coal, and when natural gas reaches $3 an MCF, they start favoring coal. So if we go into the winter and natural gas prices above $3 an MCF, of course CNX and Range Resources and EQT and all these other companies will do very well, but then we will also see that coal will probably jump in. If it is driven by supply shortages, then coal will jump in and coal producers will get the recognition from the market. So that's kind of the next thing I'm thinking about, what is going to come. I don't know when, but I will try to identify the exact pinpoint when it happens. Same as with like I mentioned with CNX, being the 9th of March when the oil price cratered completely. That was kind of the signal for natural gas to enter into bull market, in my opinion. And it's the same with Nordic American Tankers back in, I think it was September 2019, around here. That's kind of when I put my video out and bought some shares and talked about it. That was a beginning because there was the spot market had strengthened enormously over a very short period of time, and it was at a level where the valuation of Nordic American Tankers was justifying the price, and that's why I bought it. So it's kind of the way I did it, and that was, I think, the right way to do it in this period of time, because we're in a bull market there for sure. But now with the Dow Jones just absolutely folding the last couple of months, it does seem like we're in bear market territory, and there we have to buy at discounts and not wait until fair value is reached in terms of valuation. I think you just buy at a discount and then you wait for the market to give you the fair value, and then you just sell. You don't wait for a premium, you don't let things play out, you just sell, and then you see what happens. So yeah, then I guess to sum up the weekly update, I think this will probably be the most important 2 minutes or 3 minutes or whatever it's going to take of what I've been talking on my channel. If anyone's really listening, they'll probably pick up and write this down, and probably will help them in the future if they want to become serious investors. So talking about the topic of investing, like for me there's 4 key points, like what is it about. And there's this commercial by Franklin Templeton. I remember this one. I used to see it on television quite a lot back in the day, many years ago. It was about yeah, it was just about investing. I'll just see if I can pull it up on YouTube. And yeah, there we go. So this is the commercial, just Franklin Templeton commercial. It's on this Fernando Felix channel. If anyone wants to watch it, I'm not going to play it. But it's basically the key sentence in there is about it says it's about seeing first what others see eventually, and that's kind of like the essence of being like a thought leader, not a follower, not a trend follower, not people who are talking about tankers now that now that they've gone from $1.66 to $9. Of course, that's, the attention is on it because it's gone up 5x. And it's also not buying natural gas at this point. That's not being a thought leader. That's someone jumping onto the bandwagon, hoping that the macro will take the investment up in your favor. So it's like I said, it's about seeing first what others see eventually. And the second point is finding an investment vehicle that can deliver the performance. With Guyana Goldfield, it was speculative. The vehicle was unsure whether it could. And if I just stuck with better gold mining stocks, I probably would have done better in that period. But that's the way it goes. I thought it was the right choice to make at that point in time, and it just wasn't. It's the way it goes. Then the next point, number 3, is more of an emotional thing, therefore it's harder to get your head around. Like number 1, you're spotting the idea, that's easy. And then number 2 is finding an investment vehicle that can deliver the performance. That's about analyzing stocks. It's like a mathematical equation. So you have a result, and it's like the numbers don't lie. So that's kind of also easy. Point 3 is emotional, and that's harder because some people are just very emotional and can't handle stress, and other people are like a fortress. So having the courage and the conviction to let it play out and be proven right, that's number 3. With CNX, I did not have the courage and conviction to just stay long the trade and wait for it to play out. Reasons for that was because the recent past, the experience was really bad with the stock market decline. Just everything was looking very worrisome, so I had some uncertainty. I didn't know what the market was going to do. I thought in this bear market we would see it just stay low, and I assumed therefore that it would go lower, and I was wrong, and it went higher. And instead of just sticking with it and having conviction, just believe in myself, I decided to take some profits early, and that kind of like took off some of the upside. But overall I think it's okay. Number 4, this is also a difficult one, and that is knowing when others start to see it and be able to get out. So as I was mentioning about the tanker stocks, I started seeing them 2 weeks ago, and I should have been looking at getting out of them, just in case. I should have sold some more DHT and TNP, but I didn't. I sold some TNP, and then I bought it right back when it cratered last 2 days. And they kind of did crater a bit more. So you can see here TNP, it got up to like, I think it got up to like 470, and I sold like the last batch at 460, and then I bought that back at 370, and then I bought some more back at 340 from what I sold at 415, and and then it's at 320 now. So I bought it back because I think I'm right. I think it should be much higher, and I'm just going to see that if I can carry this conviction now to the end, to the finish line. Of course, if I had sold a lot more in the 4s, I would be now feeling much better about myself, but that is just the way it goes. With DHT, it's the same. It was like 860, and it's fallen all the way down to 7, so I bought back at 740 and at 715, I think or 716, I can't remember, 715 or 16, let's say, and it's at 710. So I mean, 715 is just 5 cents above. It's not material, but I did buy some back at 740 that I could have sold off at 770 or 760, but I chose that to to stick with it because I know I'm going to be proven to be right with these. So we will see what happens, of course. But in any case, point 4 is the hardest, and it's something that I've not mastered yet, because I still have like doubts about the time to sell when it comes. And it's like they say, you don't want to fall in love with the trade. And as I also think you want to be like, you want to stay in it, and you want to you want to carry it on beyond your welcome, and it's just not the right thing to do. So I do have my set of rules that I developed a while ago. They're a bit difficult to implement, but basically, if I just bring up CNX as a prime example, because I kind of have a good memory with this one for some reason. I remember back in January, I had my set of rules, of course, like it was around the intrinsic value, and I said if it gets 10% above the intrinsic value, I start selling. It got I can't remember, it was the 30th of January, it was down here. So they had the earnings come out. The earnings were of course solid and so on and so forth, and then it started rallying to 30% premium to the intrinsic value, and well, not the intrinsic value, but the pricing based on half intrinsic value. So it got to 30% here. I was not interested in buying any back, and then when it got down here, I started buying again. And when it was down here, I stuck with that. I saw it at a premium to a half intrinsic value, so I sold it too early here into the rise. I didn't believe that it would, the market would recognize this at full intrinsic value, but then it did, and then it came down, so I started buying back in. And then as it went back to half intrinsic value, I thought we were back to normal. I thought this was maybe just an abnormality, but obviously it was not. And then it was like, I think it was somewhere around here, it was like a 10% discount to the half intrinsic value, and that's kind of where it bottomed, and then it ran all the way up here. And when it got up here to 14, that was kind of a 10% premium to the full intrinsic value. And on that day that I had calculated, of course the previous days I had seen it when it was at 10 here, 1070, my intrinsic value was 1340, and around the $13 mark. So at this point in time, it was no reason to sell. But when it when it got up to 14, the intrinsic value had fallen to like $12, I'd say $12 and change, and that was kind of a clear sell signal. That's kind of when I should have exited everything, but I just sold some, and that kind of was in retrospect, it was a kind of a mistake, because when we went into earnings, I was I talked about this last week. I thought that we would be between 11 and 13 most likely. On the 27th, we started the day at 11. We rallied up to 13 and change, and then we came back down the next day to 11, and we stayed below it. We've gone just below $10 today. I think the fair value as of today, I would put it at 10.18. So we're kind of around the valuation I've calculated, and that's really a question of the natural gas price. If the natural gas price goes down, then CNX goes down, and if the natural gas price goes up, then CNX goes up. That's just the way I see it. We will see, of course, how it goes next week. On the positive front, we are starting to see some companies like Continental Resources, which I think I mentioned last week that they're not very good as an investment opportunity. They started shutting in some wells, and yeah, we will see the associated natural gas production come down. But the thing, really, the issue is that a lot of these oil and gas producers, especially the ones who are focused mainly on oil, those ones who will go out of business here, they produce very little natural gas in terms of percentages relative to the oil. So it's not like CNX and Range Resources, who, like CNX has like a very high natural gas production, because they basically don't produce any oil as far as I've seen. in most of their earnings reports. They just stick to natural gas, and Cabot Oil and Gas is also in that boat. They also just produce natural gas. So if you look at, you know, the primary natural gas producers, they could benefit from the associated natural gas production coming down, but I think like I need to look at the numbers, but I'm not sure. But I think, like, you know, the primary producers are not going to benefit that much from shut-ins of wells of oil and gas producers, as people think. It's not going to be like 90% of the natural gas is going to disappear. It's not going to be that way. But anyway, not to ramble on anymore, just we'll stick with that for this video. So as usual, remember, it's not investment advice or recommendations for you to buy or not to buy anything. I did mention Alliance Resource Partners as my top pick for the next foreseeable future, but that does not mean that you should go out and buy any or go all in just because I said so. Because if you follow people on YouTube, as we've seen with some of these Nordic American tanker investors who all of a sudden got bullish at $8-9 a share, they are all melting, and it's very unlikely that they're going to see their money back, even if they still believe. So yeah, with that said, leave any questions, comments and opinions in the comment section. If you like the content, don't forget to subscribe, and have a good day.